Okay, hopefully everybody who is attending has had a chance to join in at this stage. So once again, thank you all very much for joining our webinar this morning. Just a few logistics to begin with. We'd be planning to run this over approximately 45 to 50 minutes. So hopefully you'll have plenty of time before your next appointment. Second thing is we'll be taking questions. We'll be glad to handle anything that you might want to ask as we go through the seminar. There is a Q&A box at the bottom of your screen. If you have a question you'd like to submit to us, just click on that and you can type it in, and hopefully at the end we'll get a chance to deal with that. And just a small point to let you know about, in some cases Zoom puts the video frame for the speaker into the content area of the slide, and maybe there might be times when it might be obscuring some text, but you can just click on that speaker video box and move it wherever you wish, up to maybe the top right corner if that's happening for you. So just to mention that. Okay, so in relation to the core content, this is our banking and insurance focused webinar dealing with the Finance Number 2 Bill 2023. It's the number 2 bill actually because there was a small finance bill earlier in the year dealing with some cost of living measures. So unusually this has number 2 for the main finance bill, but we may just refer to it as the finance bill as we go on, but the official act will be the Finance Number 2 Act of 2023. A pretty historic act. There are some very, very key changes. This is the agenda we will go through today, and our speaker list on the right. We have an extra special guest, Eamon McCallan, dealing with VAT. Those of you who know Eamon won't be disappointed because Eamon's photograph appears on his slide towards the end. So as I say, we'll be focusing, albeit the bill has a very wide range of measures applicable to all taxpayers and all sectors. Our focus here is on those measures that are of most impact or potential impact for the banking and insurance sector. And there are some very significant ones. And obviously, as most of you will be aware, the key and historic change that's been brought through in this legislation is the BEPS Pillar 2 legislation, bringing in the rules on the minimum effective 15% tax rate, which has been a key project of the OECD in its base erosion and profit shifting initiative that launched since 2011. It's so key. This we describe to all of our team, especially all of our new entrants and trainees, as a revolution in corporate tax, because it truly is. It's the very biggest change in corporate taxation internationally since around the 1920s, when tax treaties started to be implemented between countries, providing for international trade and a different basis of taxation for companies worldwide. So this is huge, as you'd be aware, and it's probably the key part of our update today. But there are other measures that are of varying impact for the banking and insurance sector. New changes in relation to outbound payments and defensive measures that Ireland has had to commit to the EU to implement as part of broader interactions with the EU. There's a new measure in relation to qualifying financing companies, which brings a limited new option for deduction of interest relief on intragroup financing. There are some changes in leasing, which in some of the banking sector, will have an interest in. And there's obviously a significant change and extension to the bank levy, which Dan will deal with. There are other miscellaneous measures that we will also cover very briefly. And of course, if any of these topics give rise to questions that we can't answer here, please do feel free to contact your usual client contact to explore these further. Okay, so as I say, the headline and number 1 issue is BEPS Pillar 2. I'm going to hand over to Sandra Dawson, who, apart from leading our insurance practice, is also our lead on the BEPS Pillar 2 initiative. She's delighted, obviously, to have that role. Sandra, if you'd like to take over from here.
Thanks, Ray. Good morning, everybody. Yeah, I'm delighted to be here this morning to talk about Pillar 2. As Ray said, it's an absolute revolution in the international tax system. And I think it wouldn't be an understatement to compare it to Solvency II or IFRS 17. Huge initiatives that were talked about for a number of years and eventually arrived. I think Pillar 2 is a little bit similar, except it probably arrived a little bit quicker than people maybe had expected or hoped. When going through the presentation this morning, I'm going to assume a certain level of knowledge, but as Ray said, if there's anything that's not clear or you're not sure about, please post in the chat, or happy to chat afterwards. So I guess the first thing is, well, where are we now? So Pillar 2 is, as we mentioned, a fundamental change to the international tax system. In principle, it's designed to ensure that the largest groups pay tax at a minimum effective rate of 15% on a jurisdictional basis. So while that might seem very simple in principle, there are hundreds of pages of legislation underpinning that principle. Way too complex and detailed to get into all of the minutiae on this morning's call, given the amount of time that I have. So for this morning, what I would like to do is highlight the key principles, what you should be thinking about now, and then lastly, what are the particular nuances or provisions that are of particular interest to the banking and insurance industry. So just to stand back for a second, so the OECD designed these rules and issued rules and guidance back in 2021, 2022. So now the initial thought might have been that these rules were something that group would have to worry about, and that locally we wouldn't really need to think about them. However, as the rules have evolved, that notion has been dispelled, and Finance Bill 2023 makes it absolutely clear that the Pillar 2 rules are going to be fully enacted into Irish law, and that includes a local top-up tax regime. So regardless of what has been done at group level, local entities, if in scope, will have to comply and provide in their financial statements for local top-up tax. So maybe, Ray, moving on to the next slide. So as I mentioned, I want to touch on the key practical considerations that groups need to be thinking about over the short to medium term. As I mentioned, the rules are complex, and while the principle is to collect tax at an effective rate of 15%, that can be done in a number of ways. The primary ones that you will probably have heard about are the income inclusion rule, which essentially applies if you're in a group scenario, and then the local top-up tax if you're just looking at what has to be collected locally in Ireland. So what are the key questions that you need to be asking yourself? First of all, are you in scope? Secondly, can you avail of any of the safe harbours? If the answer to that is no, at a minimum, you will have to provide and comply with the local top-up tax in Ireland. And if you're in a situation where you have either an intermediate parent entity or an ultimate parent entity in Ireland, you will also have to comply and provide with the local or with the income inclusion rules. And then last but not least, what do you need to do for the purposes of your 2023 audit, and what evidence will you need to provide to your auditors to substantiate the position that you're taking in your 2023 accounts? So first of all, starting with scope, essentially, if the consolidated revenue of the group is at least 750 million in 2 of the last 4 years, then you are in scope of these new rules. If that is the position in the group, which a lot of you will already know, then you need to be at least thinking about the local top-up tax. and if you have an intermediate parent entity or an ultimate parent entity, the income inclusion rules. The next point for consideration is, can you avail of any of the safe harbours? So the safe harbours were introduced to minimise the compliance burden for what can be regarded as low risk jurisdictions. And essentially the OECD brought in these safe harbour rules, and they've now been incorporated into, or will be incorporated into, Irish legislation. And essentially what it allows you to do is look at your country by country reporting, and if you meet either the de minimis test, the effective tax rate test, or the routine profits test, you can essentially avoid having to do the detailed Pillar 2 computations for the first 3 years. Now, it is important to note that it's a once out, always out. So if you don't pass the safe harbours in 2024, then you can't come back in 2025 or 2026. The most common of the safe harbours that groups are looking to exclude jurisdictions from the calculations on is the effective tax rate. So essentially, if based on your CBCR data, you can show that you have a minimum effective tax rate of at least 15%, that will get you out of doing the detailed Pillar 2 calculations. If you're in a situation where you have current year losses on an ongoing basis, it's likely that you'll get out under the routine profits test. Some of the issues that have been encountered in terms of looking to rely on the safe harbours is that up to now, a huge amount of focus may not have been put on the quality or reliability of the data going into the CBCR returns. So that is a huge focus in terms of going forward to make sure that if you do want to rely on any of these safe harbours, that your CBCR data will stand up to scrutiny. However, if you've determined that you're in scope and you don't pass any of the safe harbours, which for a jurisdiction with a tax rate of 12.5%, it's not beyond the bounds of possibility that you won't pass any of the safe harbours, then you need to look at, as I said, at a minimum, preparing and providing for the local top-up tax. So this is a completely separate tax system. You're already preparing and returning your corporate tax return, but this is a separate tax return which will run alongside this. It's based on different rules, so you can't just take your existing corporate tax return and lift and shift it into the local top-up tax return, because the starting point is potentially different. There are different adjustments. So it's something that will take quite a bit of detail and effort to put together. Then after the local top-up tax, if you're doing local top-up tax in Ireland and you don't have an intermediate parent entity or an ultimate parent entity that you need to worry about, then the fact that you filed that return in Ireland should essentially exclude you from the group calculation under the IIR, which has to be done further up the chain. However, if you do have an intermediate parent entity or an ultimate parent entity in Ireland, then in addition to the top-up tax return that you will do in Ireland, you also have to look at doing an income inclusion return to bring in any of the subsidiaries of the Irish holdco into the group return. Then moving on to what do you need to be worrying about for the purposes of your year-end audit. And what evidence do you need to provide to your auditors in terms of the position that you are taking. So the rules are effective essentially for accounting periods commencing on or after 31 December 2023. So for most people in the audience, that means they will become effective for the accounting period commencing on 1 January 2024. So you might think, well, what impact does that have on my 2023 financial statements? There's a number of things to be thinking about. So IAS 12 was amended to take account of the Pillar 2 rules, and there's a couple of key features of those amendments. First of all, you are not required or are not allowed to restate your deferred tax in your financial statements to take account of Pillar 2. Secondly, where the legislation is enacted or substantially enacted before 31 December 2023, which will be the case in Ireland, IAS 12 requires you to make quantitative and qualitative disclosures around the impact that Pillar 2 is going to have on your business. And those quantitative disclosures include assessing, to the extent you can, the impact that Pillar 2 is going to have on your effective tax rate, and qualitative around what jurisdictions are in scope and what jurisdictions are likely to be impacted by the Pillar 2 rules. So a level of work to be done to determine what that disclosure should be if you're reporting under IFRS. If you're under Irish GAAP, i.e. FRS 101 or 102, then those disclosures don't have to be made in the local financial statements if equivalent disclosures have been included in the group financial statements. So in terms of preparing for your year-end audit, some of the things that you'll need to be able to provide to your auditors include an impact assessment to say either you're in scope and this is the impact, or also if there's any doubt about whether you're in scope, an impact assessment to clearly confirm that you're not in scope. So it's as important to have something to confirm you're not in scope as if you are in scope. To the extent that you're in a group that is required to do quarterly financial reporting, your auditors are likely going to want to assess your readiness and ability to report for Q1 2024. So that will be an important consideration. Have you got the data, tools, and processes in place to enable you to accurately determine what your Pillar 2 top-up tax provision in your Q1 financial statements is? And then last but not least, the disclosures that we just mentioned. What documentation and evidence have you got to substantiate that the disclosures that you're proposing to make are materially accurate and complete? Then Ray, maybe moving on to the next slide. I think the purpose of this slide is just visually, I think it's probably easier to see how the rules interact and operate, and maybe apply to your own groups, substituting the countries for what's relevant for your groups. So as I mentioned, most people are likely probably to be in the bottom right-hand corner. So you have local subsidiaries in Ireland that are going to be subject to the local top-up tax on a jurisdictional basis. And you will have to prepare and provide for, in this example, subsidiary D and other subsidiaries in Ireland, with a view to filing the first top-up tax return in respect of 2024 in June 2026. If you're in a situation where, for example, you have an Irish holding company between the US holdco and the rest of the group, as many people will know, the US is not implementing the Pillar 2 rules. So the Irish subsidiary A in that example would be an intermediate parent entity and would have to comply with the group IIR rules in respect of subsidiary A D, C, and B. So in that example, you would have a local top-up tax return in Ireland for A and D and any other Irish subsidiaries, but then you would also have an IIR return for subsidiary A and the rest of the group that are in countries where the effective tax rate is less than 15%. So Ray, maybe moving on to the next slide. So I think we wanted to move on now just to discuss some of the particular aspects which are of note to the banking and insurance industry. I think, Ray, you were going to cover the first two from a banking perspective, albeit they have wider application.
Yeah, thanks, Andrew. Yeah, these are just really quick tasters of a few, issues that are popping out as we go through the detail. So on the foreign withholding taxes, it's an important point is that the effective tax rate for Ireland is not the tax payable to Irish revenue. It's the tax borne in relation to the Irish operations of the group. And in that case, that includes foreign withholding taxes that you might suffer on trading receipts received in Ireland by an Irish office. So, for example, interest that is suffered foreign withholding tax, that foreign withholding tax, if it's irrecoverable, becomes part of your effective tax rate applicable to Ireland. And just without going into the details, what that does is that might open up opportunities to look at, for instance, lending or leasing or doing, royalty-based business to countries that maybe might have been too expensive to consider before because of the high rate of foreign withholding tax, or may mean that something that's been done where foreign withholding tax is being borne by an operation in another country in the group, maybe there might be an opportunity to do that in Ireland. Because if you are going to be ending up paying top-up tax to bring you up to 15%, then this can help to bridge the gap without paying any incremental tax to Irish revenue. Just something we're thinking about. So there are opportunities in Pillar 2 as well as costs. The second point that is particularly raising its head in the banking sector, but relevant to anybody who has losses forward on the entry into Pillar 2 regime. It's very important to consider the impact of that, because if the losses can be shown to be attributable to, or if you like, consistent with a loss calculation under these Pillar 2 rules, then you are able to uplift the rate at which that deferred tax asset is valued from its actual rate, which is going to be 12.5% for most here, up to 15%. And that means that when you use those losses, the deferred tax charge that you'll be credited for in your effective tax rate will be at 15% rather than your financial statements rate of 12.5%. So that's an important one if you have lost forward.
Thanks, Ray. And yet that one is of interest, obviously, to the insurance industry as well, with a number of entities having losses forward from prior years. I'm going to just touch quickly, in the interest of time, on a couple of the other issues. Don't want to hijack the other speakers' time completely. So just a couple to pick out. So a lot of people may be aware that there is an exclusion in calculating your Pillar 2 income for certain dividends. And equally, there's an opposite provision which essentially says that to the extent you exclude the dividend, you also have to exclude the movement in policyholder reserves that relates to that dividend. I think the insurance industry raised an issue about the difficulty in identifying and tracking excluded and non-excluded dividends. So there is an ability to elect to have all your dividends taxed, and to the extent that you make that election, then you don't need to make the adjustment for policyholder reserves. Another one which is quite important for the insurance industry is insurance investment entities. So essentially, they are investment funds such as an ICAV, which are fully held by an insurance entity to back policyholder liabilities. investment entities are treated separately from your normal entities for Pillar 2 purposes. So there was a particular issue for the insurance industry in terms of having a mismatch between the taxation of income and gains in the investment fund and the offset of policyholder liabilities in the insurance entity. So again, there is an ability to elect to have the investment entity treated as transparent, which means that the income and gains of the investment fund accrue in the insurance entity, and essentially the income and gains are then matched on the same basis as the movement in policyholder reserves. So I think in the interest of time, I will leave it there and hand back to Ray to move on to the next session.
Yeah, and just what you're seeing here is you can consult with on the slides when you receive them when we're sending them around, just to various helpful timelines I think that you've included, Sandra.
Yeah.
Okay, so we can hand on to Deirdre Rogers, who will talk us briefly through the new provisions on outbound payments.
Great, thanks Ray, and good morning everyone. I suppose just to give a little bit of background on this new legislation, it's been introduced as part of measures that Ireland would have committed to gain access to funding from the EU stimulus package arising from COVID-19. This is the final measure, and the purpose of it really is to target double non-taxation. So what does it do? So effectively what this legislation does is it removes existing withholding tax exemptions for interest, royalties and distributions in certain circumstances. So where it removes them is if you, first of all, if you're paying to an associated entity, and an entity which has effectively a 50% relationship, either through share capital, voting power, distributed profits, or what is referred to as definite influence. So similar to what we would have seen with the hybrid rules, definite influence is where one entity has the ability to participate on the board of directors of the other entity, or effectively it can participate in the financial and operating decisions of the other entity, such that that company is operating in accordance with the wishes of the first company. So where you've got one of these payments to an associated entity, and that entity then is in one of these zero tax jurisdictions, or one of the jurisdictions which are on the EU list of non-cooperative jurisdictions, then the rules potentially apply. Sorry, if you just flick on to the next one. So when does it come into effect? So it comes into effect on 1 April 2024, but there is a grandfathering provision within the finance bill. So where there's an arrangement in place before the date of publication of the bill, so the 19th of October, the rules actually don't come into effect till after 1 January 2025. So there is still some time to assess the rules and see whether they may apply. Thanks, Ray. If you just flick on to the next one. So we've just included a brief flow chart to kind of walk you through the decisions you need to consider when determining whether these rules will have an impact. So if you've got a payment of interest, royalties or dividends, are you paying them to an associated entity? And if so, are they in a specified territory? And if the answer to both these questions is yes, then you need to consider, is the payment actually excluded? So there is some carve out where the interest or the royalties or the dividends are being picked up on the other side and taxed. So if they're subject to a supplemental tax, which would be Pillar 2 or CFC, or if they're subject to another foreign tax at a rate above zero, or if you're not, in the case of interest and royalties, if you're not actually claiming a deduction in Ireland, then the rules don't apply. If it doesn't fall into one of these categories, though, you might be subject to the restrictions. Sorry, thank you. So yeah, there are some other important provisions where there's a carve out. So the corresponding payments one is effectively if you have a back-to-back type arrangement. So if you're paying to one of these jurisdictions, but within 12 months of the end of the accounting period, that payment is being onward paid to another jurisdiction, which is not a zero tax or on the EU list, then effectively what the legislation does is it looks through to the final payment and the rules don't apply. And that's kind of similar with the partnership provision. So if you've got a transparent entity in the group, you can look through to who is the ultimate partner and are they paying tax on the payment. And in that scenario, if they are, then again, the rules won't apply. There's also a knowledge test, which is helpful in the context of a quoted Eurobond or wholesale debt. So if you have a scenario where it's not reasonable to consider that you know who is receiving the interest and whether that entity is an associated entity, then you do not need to apply the rules in that scenario. And again, as I mentioned, the rules are only intended to avoid double non-taxation. So in the case of dividends, generally for an Irish company, they'll be paid out of taxed income. And in that scenario, there is no restriction. So it would only be, for example, if you're paying dividends out of some type of exempt income that you would have a restriction coming into play. So sorry, that's kind of a very quick and brief overview. To summarize, we think the application would be fairly limited. The rules do, however, just need to be considered. And if anyone has any questions, please feel free to reach out and we can address those at the end. Thanks, Ray. If you want to.
And just to add, listening to our colleagues in our structured finance, private equity sector, the main pinch point to look out for is any payments going to Cayman, because as a jurisdiction, Cayman is particularly problematic because it currently doesn't have any plans in relation to introduction of Pillar 2 rules, which means that it doesn't fall within the excluded payments. And it means that that's a particular area of focus for a lot of people. So just look out for that. Thanks very much, Deirdre. Okay, next we've just got a new provision in relation to a new type of financing company, qualifying financing companies. Dan Kelleher is going to talk us through that.
Thanks, Ray. Morning, everyone. So as Ray mentioned, the Finance Bill can introduce some new measures which, in short, permit the deductibility of non-trading interests by a qualifying financing company. So what is a qualifying financing company? Essentially what it is a company which obtains third-party financing and on-lends those funds to a direct 75% subsidiary, whereby that subsidiary uses those funds for the purposes of its trade. Essentially how it works is that the third-party interest that the qualifying financing company pays is deductible against interest income that company receives from its subsidiary. The rules contain detailed conditions that need to be satisfied, as well as certain anti-avoidance measures. So they may have limited application, but however, if the conditions are satisfied, it may be useful for certain groups that have maybe a financing vehicle that its activities are not sufficient enough to constitute a trade, or may provide an alternative vehicle, say in comparison to a Section 110 securitization vehicle. So yeah, look, that's just a brief overview of the rules. Again, if anyone has any questions on that, we'll be happy to help.
That's great. Thanks very much, Dan. Okay, and while we had a separate sectoral update for the aircraft finance and leasing sector, which you will have access to the recording of, we just thought we'd summarize very briefly some leasing changes that some of you may be interested in. The key change is that in taxing the trade, as we say there, the leasing income and deductions for lease payments are generally to be spread evenly over the life of the lease. So as any of you involved in leasing will be aware, there's been a lot of uncertainty and absence of revenue guidance, and draft revenue guidance that actually wasn't appropriate over the last few years. So legislatively, this has now been dealt with, and subject to exceptions, this is now going to be the new rule, and it's quite a difference to what we're used to in terms of excuse me, in terms of looking at the payments, or in some cases the accounting basis. Now, important to know what the exceptions are. The main exception that's been legislated for here and updated is for leases where the burden of the wear and tear falls on the lessee. And there was a practice around this that used to address a legislative anomaly that could have overtaxed lessors, but now this has been codified in legislation, thankfully. Important also to note that what isn't changing is the regime for short life assets that can follow the accounting treatment where an election is made under Section 80 capital A of the Taxes Act. So that is not affected by this. The other change then, the other main change, I suppose, is around the definition of the Section 403 ring fence provisions, defining what is within the ring fence of leasing business and what can be offset against capital allowances arising from this business. And it's just bringing in what the legislation refers to as certain lease adjacent activities, which mightn't have been necessarily clearly within scope and available to be treated as part of the leasing business before. And this includes things like provision of finance to associated group lessors. And there's a range of conditions there and certain requirements around that, but we won't go into this. As I say, you will have access to a fuller discussion of this on the leasing and aviation finance sectoral update. And as we mentioned there are also increases in the level of details to be reported in relation to ring-fence leasing business, which will be specified in an updated Form CT1. Okay, so moving on from that, we thought we'd just pick up on a few miscellaneous items of relevance to the banking and insurance sector. First one is a slide all to itself, bank levy. Dan, you're going to take us through this.
Yeah, thanks, Ray. So as most of you know, the bank levy has been extended to 2024. There has been certain key changes to the levy, however. So first, in terms of scope, the levy is confined to banks that receive state assistance following the financial crisis. So that would include AIB, EBS, PTSB, and Bank of Ireland. This is a welcome change, especially for international banks that are operating in Ireland, as they clearly fall outside the scope of the rules now. As well as the change to the scope of the rules, there's also been some key changes to how the levy itself is calculated. So rather than the levy as it was previously calculated based on the amount of dirt certain financial institutions paid for a particular year, the levy is now calculated based on the amounts of customer deposits which are within the scope of the deposit guarantee scheme, which are maintained by the in-scope banks as at 31 December 2022. And that those deposits are multiplied by a stamp duty rate of 0.112%. It's probably worth noting that in Sinn Féin's alternative budget, it contained proposals whereby the target for the levy was 400 million. There was also some proposals there on the denial of corporation tax relief for banks that received state assistance following the financial crisis. As announced in the budget, the target yield for the 2024 levy is 200 million. At this point in time, the levy has been extended to 2024, but it'll be considered further next year whether the levy will be extended beyond 2024. And probably just another point to note is that the levy is now within the scope of the tax-geared surcharge and penalties, similar to other levies such as stamp duties on financial cards. So I guess that's a kind of whistle-stop tour of the changes to the levy, but I'll hand you back to Ray now.
Great, thanks, Dan. Yeah, and the key point you mentioned there certainly gives more certainty to the international sectors where some, on occasion, one or two might have tripped into the levy. That can't happen under this revised levy, and hopefully any further revision will keep it confined the way it is for the international sector's sake. Okay, so just very, very quickly, a whistle-stop tour of a few other points. Those of you in the retail banks will be aware of the mortgage interest relief, and probably breathes a sigh of relief that you don't have to change your systems to allow for claims for 1 year relief by the customers. So that's good. Mary, I think you're going to deal briefly with the next.
I am. Thanks, Ray. Good morning, everyone. So I'm going to quickly run through the pension changes in the finance bill. So the first one there, the second bullet point in the slide, is that Irish Revenue will not approve any new applications for retirement annuity contracts or RACs as they're commonly known, from 1 January 2024, except where an application under Section 7084 of the Taxes Consolidation Act, which governs RACs, has been made before this date, so before 1 January 24. Section 784A, which provides for the taxation treatment of an approved retirement fund, or ARF, has been amended to impose a tax charge on the ARF owner where assets of an ARF are used as a loan or security for a loan to a closed company. and the ARF owner or any person connected with the ARF owner is a participator in that company. In such cases, this will be deemed a distribution on which income tax will be payable. Similarly, a tax charge will also apply to the beneficiary of an occupational pension scheme, a personal retirement savings account or PRSA, and a pan-European personal pension product where assets of such a scheme or product are used by the beneficiary, again, similar to the ARF, as a loan or as security for a loan to a closed company. And the beneficiary or any person connected is a participator in that company. Then section 787K, which provides for Irish Revenue's approval of PRSAs, has been amended to allow new and existing PRSA holders to now commence withdrawals from their PRSA beyond the current upper age limit of 75 years. So essentially, the bill has removed the age restriction to access one's PRSA. Finally, and I guess it's not included in the finance bill, but I guess we just wanted to bring it to your attention today, was that the Minister for Finance has announced that the motor insurers' insolvents compensation fund levy will be reduced to 1%. So as you may be aware, the fund was established back in 2018 to collect contributions from motor insurers to fund the increase in compensation for third-party motor claims to 100% in cases where an insurer is insolvent. The levy is subject to annual review by the Minister for Finance and can be set between 0% and 3%, depending on factors such as the amount in the fund or the likelihood of a call being made on the fund. And the levy has, as I said, the levy has been reduced from 2% to 1% of gross motor insurance premiums, and should benefit policyholders renewing motor insurance policies from 1 January 24. So I guess that's kind of a whistle stop of the other sectorial items. I'll now hand over to Eamon to talk through some specific VAT aspects of the finance bill.
Just to pick up very briefly on that section 895 points, just for those of you who are familiar with this, it has been obligatory for somebody opening a foreign bank account, which can include an account with the head office, even of a bank that has a branch in Ireland, to have to report details of opening that account on their tax return for the year. And if they didn't have to file a tax return, it meant they had to file a tax return. So quite onerous. It's been relieved slightly in that for individuals who don't otherwise have to file any tax returns, they don't have to make any report if the account would be subject to FATCA CRS reporting. Wording is not quite 100% clear as to how the person is supposed to know definitively that it will be subject to FATCA CRS reporting, but I think hopefully guidance will make that clearer. Okay, thanks again, Mary. And as Mary mentioned, we'll now move on to a brief update on VAT and CSOP from Eamon McCallum.
Morning all. So first change I'm going to talk about was in the budget. Revenue launched a public consultation on modernising Ireland's VAT system. It's now open. It runs up to the 12th of January, and there's been lots of talk this morning about pretty revolutionary tax changes. VAT modernisation actually has the potential to be quite revolutionary. Also, it's likely to have a really significant impact on your information systems and finance processes by the time it actually comes in. There's a number of drivers behind it. So one of them is, revenue went through PAYE modernisation now quite a number of years ago, was seen as a great success, and it was always on their roadmap that VAT will be next. I know from talking to revenue, they also feel that Ireland's kind of getting left behind on digitalising VAT. So quite a lot of the European Union countries have already embarked upon a digitalisation journey. Some of them are like 10 years into that journey. So Ireland doesn't want to get left behind. And then probably one of the biggest drivers is at EU level. So the EU currently has a set of proposals out called VAT in the Digital Age, VIDA. And there's a whole raft of changes there, but the ones that are most relevant to banking and insurance are mandatory e-invoicing and real-time digital reporting. So under those, the one easy aspect of it is that the VES returns, which everybody obviously loves, will be abolished, but what's replacing it's going to be well more onerous. So for all cross-border trade between EU member states, both the supplier and the business customer are going to have to get into digital real-time reporting. So the supplier is going to have to issue their invoice electronically, and the particular format of that's still up for debate. But within 2 days of issuing that invoice, both the supplier and the purchaser are going to have to report quite a lot of invoice level details of that transaction to their national tax authority. And then 1 day later, their national tax authorities will report that on to the EU Commission. And if you're a business that either makes or receives quite a lot of invoices, 2 days is going to be very quick. So like pretty much every single day, you're going to now be doing a sort of a VAT reporting almost under that proposal if you're receiving a lot of them. The Irish proposals are quite a bit wider than the EU ones. So they're taking the EU ones, which are focusing on cross-border business to business and business to government, and they're extending them to the domestic arena also, into domestic invoices. So the Irish proposals at the minute are for mandatory e-invoicing for domestic transactions and also some form of digital VAT reporting. The first phase will, similar to the EU, focus on business to business and business to government transactions, and then phase 2 will pick up business to consumer. One of the big questions is whether it's going to cover exempt supplies, and that's an open question right now. At EU level, the answer to that is it's not currently in scope, but they are just proposals, so there's still talk of it. But before you say a relief on that one, even if you're not obliged to report your outbound exempt supplies, you'll still be caught within e-invoicing and digital VAT reporting, because any purchase that you make from outside the state that triggers a reverse charge currently, you're going to be obliged to report that out under this digital real-time reporting within 2 days. So you're still going to end up having to put in place the systems to make or receive e-invoices and to make digital real-time reporting. Revenue locally still has to decide if they're going to require e-invoices for exempt domestic supplies. And right now, no VAT invoice is actually required for those invoices. But I know from talking to Revenue, they do see benefits in taxpayers having a single centralized invoicing model that would cover, both their domestic transactions, their cross-border EU transactions, and domestic taxable and exempt. But they've absolutely made no decision whatsoever on that. That's what the consultation's for, and they really do want to hear from taxpayers what their thoughts are on it, particularly if you're a small business. So they think that they have a fair idea from large businesses what some of the issues are, but they want to hear from large businesses what their experiences are of what's worked well and hasn't worked so well in other territories that have already rolled this out. So anyway, that consultation's open and is available to all. The touch on CSOP briefly. So this is the new cross-border payments reporting regime, which now goes live on the 1st of January. So a little bit scarily, that's only 7 weeks away. CSOP didn't make it into the finance bill. It was intended to previously, but Revenue has decided that it's going to be passed by way of ministerial order. Timeline, they're telling me, well, obviously it has to be before the 1st of January, so it's going to be in the next few weeks. So we wait to see that, although I think we have a fair idea what it's going to say. If you're a bank or a payment service provider and you want to discuss your CSOP requirements, just feel free to reach out to us on that, because I suspect most people have already started their journey. What did make it into the finance bill itself on the VAT side was quite light on the VAT changes. I mean, there was a few technical changes. One of them was Revenue abolished the right to seek a VAT rate determination. They said it wasn't being used. Probably wasn't being used a lot, but it's more accurate, I would say, that taxpayers were seeking VAT rate determinations and Revenue weren't giving them. Instead, Revenue were giving guidance on them. Main issue is that a VAT rate determination was appealable, whereas Revenue guidance isn't. The other aspect that probably has a little bit of a quirk to it that's going to need a little bit of figuring out yet is Revenue has removed the VAT exemption for issuing stock, shares, debentures, and other securities. Revenue say that's only a technical tidy up. They started that tidy up a year ago, and they say that the word issuing got left behind, and that it has no impact since issuing shares to raise capital isn't exempt. It's actually outside the scope of that. There's a potential problem with that where shares are issued but not to raise capital. So say, for example, in a reorganization where you might have a share for share exchange, clearly the shares in that instance haven't been issued in order to raise capital. That was a transaction that previously would have been exempt. And I guess because it's now not exempt and now also not something that's outside the scope of that, it does raise the question, well, does it default back to being taxable, which would obviously be a terrible answer. So we've raised questions with revenue on that, and they're considering that at the minute. And then the other sort of corollary of that is there's certain services right now which rely on the wording issuing of shares in the Act for exemption. So any sort of intermediation or agency services in relation to the issue of shares, which are currently exempt, clearly can't be exempt if the issuance itself is no longer exempt. So probably only has a small impact, but could impact on certain corporate finance fees and others that we see in the area. I suspect is what usually happens in these types of issues is when revenue issue a technical tidy up which has implications that maybe they just haven't caught, they'll try and fix it afterwards by way of guidance or something else. So that's my very quick whirlwind through some of the recent VAT changes.
That's great. Thanks very much, Eamon. Sandra, if you'd like to just talk us through timeline for the bill.
Yep. Thanks, Ray. So as I mentioned earlier, we're expecting the finance bill to be signed into law before the end of December in line with previous years. We have already had the committee stage amendments. Report stage is 21 to 22 November, and then the intervening SHANAD stages culminating in the bill being enacted into law as the Finance Act number 2 2023 before the end of December, as I mentioned. Then just before I wrap up, there have been a couple of questions into the chat box which we'd like to deal with. First of all, on outbound payments. So for Deirdre, does corresponding payment have to be the same form as the original payment, i.e. interest in, interest out, or can it be interest in, dividend out?
Yeah, no problem. So the legislation, actually, it doesn't talk about a corresponding payment. It talks about a corresponding amount. And if we look at the hybrid rules, generally where there is a reference to a corresponding amount, it tends to be fairly flexible. So in that scenario, what you're doing is you're looking at the second payment and whether that payment would fall into the category of an excluded payment. So if it is interest in and dividend out, would that dividend fall within the excluded payments category? So it's not necessarily it's interest in, interest out. It's just that you effectively ignore the first payment and you look at the second payment and see would that fall into one of the excluded categories.
Okay, thanks, Deirdre. And then the second question was around whether the point which I discussed around excluded dividends and policyholder reserves only relates to the insurance industry. And yes, those the requirement to disallow the equivalent increase or decrease in policyholder reserves related to the dividend is specific to the insurance sector. However, the election for entities that want to include all dividends in Pillar 2 income, if that is of benefit or is easier from an administrator's perspective, is not limited to the insurance sector. Any entity can make that election. So I hope that answers the questions which were posted in the chat box. As we mentioned earlier, if there are any additional questions or any follow-up clarifications required, feel free to get in contact. I think that just leaves me with wrap up. I'd just like to thank everybody for attending. I hope you found the session useful. We will be sending out the slides, or a link to the slides and the recording of this session, and likely the other sector specific sessions which were done earlier in the week, with one to follow next week. And last but not least, if you have any feedback on the session or any suggestions as to topics that we may cover in future sessions, please let us know. So thanks everybody, and goodbye for this morning.